Something strange is happening in the UK housing market right now. Prices are climbing higher and higher, yet fewer people are actually buying homes. It doesn't make sense at first glance. When prices go up, you'd expect more activity, more competition, more sales. But the reality playing out across Britain tells a completely different story. The property market is grinding to a halt even as values continue their upward march. If you want to stay ahead of what's really happening in the UK property market, hit that like button and subscribe to Property Reporter for all the latest news on the economy, housing, and everything in between. The numbers paint a picture that most people aren't seeing. Property sales have dropped to levels we haven't witnessed in over a decade, excluding the pandemic years. We're talking about transaction volumes that would normally signal a market in serious distress. Estate agents are reporting viewings drying up, offers falling through, and chains collapsing at the last minute. Yet, when you look at the price data, it shows something entirely contradictory. Average house prices in many regions are still ticking upwards, defying the lack of buyer activity. This disconnect reveals something deeply unusual about the current market dynamics. Mortgage rates are the silent killer in this scenario. When interest rates sat near zero for years, buyers could afford much larger loans with monthly payments that seemed manageable. Now, those same properties require mortgage payments that are sometimes double what they were just 2 years ago. A family that could comfortably afford a £400,000 home in early 2022 is now struggling to get approved for £300,000. The math simply doesn't work anymore for millions of potential buyers. Lenders have tightened their criteria as well, making it harder to qualify even if you can technically afford the monthly payment. First-time buyers are being hit especially hard because they don't have existing equity to cushion the blow of higher borrowing costs. Sellers are refusing to accept reality. This is where the price paradox really takes shape. Homeowners who bought or remortgaged during the low-rate era often have tiny monthly payments locked in for years. They're in no rush to sell, and when they do list their properties, they're setting asking prices based on the peak values from late 2022 and early 2023. They remember when their neighbour sold for a record sum, and they want the same. But the buyers who could afford those prices back then simply don't exist in the same numbers anymore. The result is properties sitting on the market for months, with sellers either pulling listings or making tiny price reductions that don't reflect the real affordability gap. This stubbornness keeps official price indices elevated because the only sales going through are either exceptional properties, desperate situations, or buyers with large cash deposits who aren't as affected by mortgage rates. The rental market is making everything worse. People who would normally be saving for a deposit are instead facing rent increases that eat into their ability to put money aside. Landlords are passing on their higher mortgage costs to tenants, creating a vicious cycle. Would-be buyers are trapped, paying more in rent than they would for a mortgage, but unable to save the increasingly large deposits that lenders now demand. Some estimate suggest first-time buyers now need to save for over 15 years in many parts of the country to afford a typical deposit. That's almost double the time it took a decade ago. Meanwhile, those who are renting are building no equity, falling further behind property owners, and watching as the goal of homeownership drifts further out of reach with each passing month. Regional variations tell us even more about what's really happening. In London and the South East, sales have dropped more dramatically than almost anywhere else. These high-value markets are incredibly sensitive to mortgage rate changes because the loans are so much larger. A 1% increase in interest rates might add £100 to a monthly payment in the North East, but it could add £400 or £500 in parts of London. Buyers in expensive regions are either pulling out entirely or looking much further down the property ladder than they initially planned. Meanwhile, some areas in the North and Midlands are holding up slightly better, though they're far from immune. The gap between what people can borrow and what homes actually cost has widened everywhere. It's just that in cheaper regions, there's still a narrow band of properties that remain accessible. New build developers are starting to panic. They ramped up construction during the boom years, expecting demand to remain strong. Now they're sitting on completed homes that aren't selling at the prices they need to turn a profit. Some are offering incentives like stamp duty contributions, free upgrades, or even shared equity schemes to get buyers through the door. But these sweeteners often hide the fact that the base prices remain inflated. Industry insiders are whispering about developments being mothballed, projects delayed, and land options being dropped. When developers stop building, it creates future supply problems. But right now, they're more concerned with shifting existing stock than planning for 5 years down the line. The construction sector is already seeing layoffs and reduced working hours as the pipeline of new projects dries up. Government intervention seems unlikely to change much. Politicians talk about supporting first-time buyers and increasing housing supply. But the fundamental problem is affordability driven by interest rates, which are controlled by the Bank of England based on inflation targets. Unless rates come down significantly, the mortgage payment equation won't improve enough to bring buyers flooding back. Some economists are predicting rate cuts in the coming months, but even if they materialise, they're likely to be gradual. A quarter-point reduction here and there won't suddenly make homes affordable again for the millions priced out over the past 2 years. Schemes like Help to Buy have wound down, and there's little political appetite to introduce expensive new programs when public finances are stretched. Stamp duty thresholds could be adjusted, but that only helps at the margins and does nothing for buyers who can't get a mortgage in the first place. What comes next could reshape British property for a generation. If sellers finally accept lower prices, we could see a correction that brings values more in line with what people can actually afford to borrow. That would mean pain for recent buyers who might find themselves in negative equity, but it would open the market back up and get transactions flowing again. The alternative is a prolonged stalemate. Very few homes change hands, prices stay nominally high but nobody's actually buying, and an entire generation remains locked out of ownership. Some analysts think we're heading for a slow, grinding decline in real terms, where prices don't crash dramatically, but inflation erodes their value over years while wages slowly catch up. Others believe a sharp correction is inevitable once enough sellers get desperate. Either way, the disconnect between rising prices and collapsing sales can't last forever. Something has to give, and when it does, the impact will ripple through the entire UK economy in ways we're only beginning to understand.